How are recent economic uncertainties and geopolitical events affecting our approach to investment-grade portfolios? Hi, I'm Arvind Narayanan. Today, I'm discussing the impact of market uncertainty on investment-grade bonds, as well as some key trends in how they're evolving. I'll also provide insight into how we select individual credits within a portfolio and some thoughts about opportunities and risks in other fixed income sectors. The punchline is valuations are rich. Investment grade spreads are at multi-decade tights, the first percentile over the past 10 years at least, and this makes valuations extremely unattractive for spread investors. The all-in yields are incredibly attractive. One of the key components for investors in the fixed income market is income, and currently investors can gain almost 5% of income investing in investment-grade credit. And that's at a 6-year duration. For comparison, investors need to go out to the 30-year point on the US Treasury curve and take on incredibly more interest rate risk to realize the same level of yields. And we expect over the next 12 to 18 months, both of these trends to continue in the market, where spreads we expect to be fairly range-bound and all-in yields right around that 5% level. What we've seen is the equitization of the credit markets overall. This is largely because of the increased adoption of ETFs, and this is leading to transactions in the marketplace where investors can transact in a large diversified basket of individual securities to trade their risk in their portfolios. This is leading to increased liquidity and greater depth in the markets. And we expect this trend to continue to accelerate over the next 12 to 18 months. Risk management is critical in the way we manage our fixed income portfolios to generate long-term returns for our clients. In the current environment, where there's heightened macroeconomic and geopolitical risk, the importance of risk management is paramount. As we look ahead in the markets, with valuations being extremely rich, we are limiting the amount of aggregate risk we're taking in the portfolios because this fits with our overall philosophy of generating strong risk-adjusted returns while limiting downside in the portfolios. In periods of heightened economic and geopolitical stress, different parts of the economy are going to grow at different speeds. This will naturally lead to increased opportunities for sector and individual security selection. And that is where our teams are focusing our time on now. Individual security selection is the bread and butter of how we generate returns in our portfolio. To help us do this, we have an incredible team of deeply tenured research analysts. On average, they have over 16 years of experience in the industry that gives them incredible insight into their industries. As we look at credits, the foundation of our research process starts from rigorous fundamental analysis and financial stress testing of companies. We stress their outcomes under different scenarios to really stress how their balance sheets will hold up. We assess their business risk, assess company management, their corporate governance, their culture, and the overall industry, the cyclicality of the industry they're in, the competition, the barriers to entry. Will this company survive in any economic environment? And these form the foundations of our overall research process. As we're looking at these credits, we're constantly asking our analysts whether there are truly idiosyncratic opportunities in this company, that the company itself can control the outcome regardless of the economic environment, or is this company's outcome very reliant on the overall macroeconomic environment? In times like this, with very heightened macroeconomic stress, we favor companies with significant idiosyncratic opportunities because we have confidence with our analysts that these companies are going to be the winners over the long term. When we look at valuations across the fixed income marketplace, valuations broadly are rich. This makes us pretty conservative in the amount of risk we want to deploy in our portfolios. Our overall economic outlook is that of a slowing economy, but no imminent recession. In this case, we do think that the markets are susceptible for a sharp sell-off in the event of an external shock. There's very little value cushion. So when we are looking at our portfolios, we want to position up in quality and exposed to sectors that have lower beta or lower risk to the overall market. This makes us overweight agency mortgages. It makes us overweight high quality credit such as structured products. And it keeps us underweight in higher quality, in higher leverage sectors such as high yield. At the same time, when we think about sectors such as high yield or emerging markets, these are sectors where there can be incredible dispersion as the economic outlook evolves. So our team is very focused on making sure we're picking the right names, the right credits within these sectors that give us that incremental yield, that incremental performance while minimizing downside risk. Overall, when we look at the opportunity set for our core bond and core plus bond funds, we think this is the right time for us to be patient. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.